Good afternoon. Welcome to our webinar on the magic of management buyouts. The webinar this afternoon is being recorded just for anybody who misses it so they can watch it later. But no personal information from any of the attendees is recorded. There's no, you remain anonymous on the webinar and on the video. What we're going to cover over the next hour or so, which will consist of probably 45 to 50 minutes of us presenting this webinar, followed by questions. We're going to cover a bit about us, why we're qualified to talk about management buyouts, what's our experience. Then my colleague Greg is going to join and talk about the magic ingredients for a management buyout and look at the management buyout and why it is magic from a vendor's perspective and then from a management team's perspective. We're going to talk briefly about funding a management buyout, and then towards the end, a bit about how we can help to facilitate the management buyout and make it happen. Followed by questions at the end. Please feel free to ask questions at any time using the Q&A facility that's either at the top of your screen or the bottom of your screen, depending on how you're viewing this webinar. And we'll pick up all those questions at the end, but please feel free to type your questions in at any time and we'll pick up on the questions at the end. So just a very brief introduction to strategic corporate finance and our experience in doing management buyouts. We've been going over 20 years, we're in our 22nd year now, and we advise clients on transactions, and most of the transactions we do are either management buyouts or trade disposals. We've done a lot of management buyouts, and you'll see a few of those on the next slide, which shows some thumbnail images of the management buyouts. And we enjoy doing management buyouts, and for many clients who are looking to sell, or vendors looking to sell, a management buyout can be a viable option. For other vendors looking to sell, the trade sale is the more viable option. We believe in giving a lot of early stage advice so that clients embark on a route that is feasible and understand where it's going to lead them in terms of the value and how the transaction is likely to be structured and how the business will be impacted. So before getting on with a transaction, we do a lot of early stage advice. We provide a lot of valuations, and our valuation reports are typically 20+ pages long and give our commentary as well as the calculations and the explanation as to why the calculations are done the way they're done. We do a lot of feasibility reports, particularly management buyout feasibility reports and trade sale feasibility reports, looking at what can be achieved. So a client has clarity on where the transaction's likely to lead them before they embark on it. In terms of trade sales, we do a lot of research using subscription databases to find potential buyers for businesses worldwide. But in many cases, I say we're carrying out management buyouts, sometimes acting for the outgoing shareholders and sometimes acting for the management team. So the skill is structuring the transactions at a value that makes sense, that can be funded and delivered. So really the early stage advice, the early stage work is vitally important to make sure what we then embark on to deliver can be delivered and is feasible. So nobody's got false aspirations as to what can be achieved, and the deal can be delivered. With management buyouts, there's usually a significant element of fundraising required. Not always, there's different ways of structuring a deal. And ultimately, our job is to get the transaction over the line, not at any cost, the right transaction for our client and the right transaction for the business almost always. Our skills are, we have a small team, we've worked together for many, many years, over a decade together. We work well together, we all are involved in every transaction. And really our experience, integrity, perseverance, our independence, and it's a personal service, are our strengths and why we get work recommended to us, because most of our work comes through accountant recommendations, former client recommendations and solicitors recommendations. Some of our management buyouts are shown on this slide. The same thumbnail images appear on our website and are clickable. There's quite a few, we've done quite a few management buyouts since we put this slide together, many of which are on our website. We enjoy doing management buyouts, and we find the outgoing shareholders often wish to do a management buyout to let the people who have been involved in helping create the wealth with them, take the business forward and on to the next stage. So at this stage, I'm going to hand over to Greg, who's going to take us through most of the content, and I'll come back in at the end to talk a bit about how we can help. And then Catherine will also join both of us at the end to host the question and answer session.
Can you hear me? Hello, hi. Thanks very much, Andrew. I'm just struggling to find my video at the moment. 1 second. Sorry about that. Good afternoon, everybody. Yeah, first of all, magic ingredients for a management buyout. There's not many really. I think we find that most businesses that we advise are suitable for management buyouts. The first one is that a business needs to be profitable and cash generative, and that's needed to fund the transaction. So really the only businesses that aren't suitable for a management buyout would be sort of early stage businesses or loss-making or distressed companies. The second magic ingredient would be where the owner or owners are looking to sell, and far and away the most sort of common situation we come across is where business owners are looking to retire, and a management buyout is quite often an appropriate exit route for them. And the third and final ingredient would be an ambitious management team with the desire to take over the business and help it move forward. The ideal scenario would be one where there's a management team running the business already without any involvement from the owners. But in the world of SMEs, that's less common. Usually the owners are actively involved in managing the business. And that doesn't mean that a management buyout it isn't possible. With a buyout, it's possible for the owners who are actively involved in managing the business to gradually sort of give up their management role over time, and maybe sort of move into a non-executive chairperson position as part of the buyout. And a buyout enables the owners to remain involved after the transaction's happened, and quite often that's an attraction for them versus other exit routes such as a trade sale. Moving on to the magic ingredients, the magic of management buyouts for vendors, for owners of businesses. The first one I'm going to talk about is that a management buyout gives the owners an opportunity to realise the maximum value for their business. And that sometimes there's a bit of a misconception amongst business owners that they will get the highest value for their company by finding a trade buyer. And sometimes that's the case, especially if there's an opportunity for a trade buyer to realise significant cost savings or synergies from buying a business and combining it with their own group. And in those sorts of situations, you might find that they pay what we call a strategic premium for a business. But in most cases that we sort of come across, it's more likely that trade buyers will negotiate quite hard on price, and that's a way of mitigating their risk on a transaction from the point of view of a trade buyer. The money they're paying for an acquisition is entirely at risk if the business underperforms after they've acquired it, and they've effectively overpaid. Then the way they can try and sort of control that risk, as well as through extensive due diligence, is to try and pay as little for a business as they can get away with. Contrast that with a management buyout. Is quite often the case that you can structure a deal which has a higher valuation that might be achieved than through a trade sale. That's partly because the owners of the business in that situation have quite a strong negotiating position, and that's because they can, within reason, control the price they want to sell, to receive to sell their shares. They can control the timing of a management buyout in almost all cases. And in most cases, they are required to help fund the transaction, and therefore that gives them further leverage in that they're, as well as being a seller in the transaction, they're also one of the funders, and they've got quite a strong negotiating position from that point of view. The second reason is that the concepts that the price that the vendors are receiving for their shares is a different from what the management team are actually paying. So if you think about it, if there's a management buyout where the vendors are receiving £1 million for their shares, that's not the same as what the management team are actually paying. The management team might only be investing a small proportion of that money, maybe £100,000 from their own sort of personal resources, and then the bulk of the consideration is going to be funded through the company, either borrowing money to be paid to the shareholders at completion, or the company funding further payments in the future. So from the point of view of the management team, it's what they are investing personally, which is the most important thing. And that's what they ought to be sort of focusing most on, rather than the amounts that the shareholders are receiving for their shares. The second sort of magic feature of management buyouts for vendors is the opportunity to reinvest part of what they receive for their shares into the acquiring vehicle back into the company, and receiving a minority shareholding in the company going forward. As I mentioned on the previous slide, it's very common that in management buyouts, the vendors would receive would be a funder to the transaction and receive part of their consideration on deferred terms over a number of years. And obviously that's a downside to buyouts from the point of view of vendors. They've got to wait several years before they get all of their money from the deal. But that, on the flip side, that presents an opportunity for them to reinvest part of their the proceeds, become a minority shareholder in the company going forward, and then there's an opportunity for them to sort of receive some compensation on a commercial basis for the risk that they're taking in waiting several years to receive all of their cash. And that sort of a retained minority stake, structuring the deal in this way can make a really sort of huge difference to the overall deal value that they receive, which I'll talk about on the next slide. And quite often, it's not the case that business owners need to receive 100% of the consideration in cash at completion. Very often, they're independently wealthy and can afford to wait several years before getting all of their money. And even if they were to get 100% of their consideration in cash at completion, you've then got the problem of what you do with that money and where you invest it in order to get a continuing return on that money. So if we look on the next slide, this gives an example to sort of talk through. So let's say that you've got a management buyout transaction with a £3 million value, and a bank provides just over half of the required cash through a loan to the company. The management team, let's say there's 3 members of the management team, each contributes £50,000 of their own money for 75% of the share capital of a new holding company that would be incorporated for the purpose of the buyout. And let's say that the vendors use £50,000 of the proceeds from the deal to invest into NewCo, into the new holding company, alongside the management team on exactly the same terms. And they receive 25% of the new holding company for that money. And then the balancing figure is £1.1 million being deferred consideration that the vendors would receive in the few years following the transaction, and that money would be funded by the future profits and cash flows of the business, along with the bank loan of £1.7 million. So in this example, the vendors would receive a total of £1.85 million at completion, mostly being the money provided by the bank through a loan. They would receive another £1.1 million on deferred terms, and let's say in this example they receive all that money after 5 years. Their 25% stake in the company, let's say that the value of the business remains completely unchanged during that 5-year period. So it was worth £3 million when it was sold to the management team. Let's say that the profitability remains constant during the period after the transaction takes place, and it's still worth £3 million in 5 years' time. If the former shareholders then have a 25% stake, that would be worth £750,000, which they've paid £50,000 for initially. So the total amount of money that they've received from the deal, including the point where they sold the company for £3 million, plus the selling their 25% stake in 5 years' time, they would have received £3.7 million in total, being a 23% premium over and above the £3 million valuation. So you can see in this example that they've made a far better return through using this sort of structure than they would purely by selling out completely in one go. And as I mentioned on the previous slides, that might suit the vendors. Very often, they don't need to have all of their cash straight away. They might prefer to have some of the cash at the point they sell the business, reinvest some, and then earn a commercial rate of return on that continued investment. And if you think about it, where would it be better for somebody to invest their money than a business that they've previously owned, understand everything about? You're much likely to get a better rate of return on that sort of investment than you would putting your money into listed investments or elsewhere. The third sort of magic feature of management buyouts for business owners is that who you're selling to. So in almost all cases, the management team will have a good relationship with the owners of the business. Otherwise, you wouldn't be considering a management buyout. Because you've got that trust and goodwill already there, it makes the deal much easier. It avoids the time and expense and trouble of going out into the market and looking for a buyer for your business. So that can be at worst a sort of distraction, but can be quite damaging if you kind of go through a long process looking for a buyer. And that can be very expensive. You could have a deal fall through right at the very end. So you can avoid all that hassle by just sort of doing a deal with people that you already know and trust. A management buyout process tends to be easier than selling to a third party, and that's again because you already know the individuals involved. There's less of a requirement for due diligence on the part of the management team anyway. If they work in the business and understand the markets it operates in and its customers and suppliers, then there's far less need for due diligence there. A trade sale process can lead to confidentiality issues. So very often clients of ours are concerned about letting other companies in their market find out that they are for sale, in case their customers find out about it, or the client's staff. And there's the risk of opening up to competitors, and potentially sort of giving commercially sensitive information to other organisations. So with a management buyout, you can keep everything in-house and avoid those kinds of confidentiality issues. And in many cases, there's an even stronger reason to sell to the management team, and that is, we regularly advise family businesses on management buyouts, where there's a need to transfer ownership of a business from one generation in the family to another, and very often that's a good way of passing the business down rather than waiting for an inheritance event. It's often a good way of ensuring that every member of a family is treated equally. So there might be some members who aren't involved in the business, and it's appropriate for those individuals to be be paid out and receive sort of fair compensation for their their share of a business, and at the same time concentrating the equity and the control of the family business in the hands of those individuals in the family who are actually running it day to day. The fourth magic feature of management buyouts is that it gives an opportunity for business owners to secure their legacy, and legacy is a word that crops up very regularly when we're talking to clients. It's often as important as the financial aspects of a deal, and it's things such as wanting the business that they perhaps have founded and grown and nurtured for many decades to continue and remain successful in the future, to remain independent, and not sort of be absorbed into a larger organization and lose its name and ethos. Remaining independent also means that there's no need or no risk of any sort of major changes to the business, or any redundancies or job losses. And management buyouts are also often a catalyst for helping the business develop. So it might be a case where a business has sort of been owned by one person or one group of people for many years or decades, and has maybe plateaued, and a management buyout gives an opportunity for the sort of next generation of management to bring their own ideas into the business and help it move forward. So management buyouts can often sort of be a good thing for the company itself from that point of view. And finally, in terms of legacy, management buyouts give an opportunity for the owners of a business to remain involved and have an ongoing sort of influence over the business after the point they've sold it. And this could be through retaining a minority equity stake, as we've talked about. It could be they remain in a management role and gradually phase out over a number of years before completely retiring, or it could be that they move into a non-executive role straight away, and just help to sort of mentor and guide the next generation management going forward. So there's lots of sort of soft issues there to consider, which can make a management buyout an attractive option for business owners, rather than the trade sale route. The fifth sort of magic feature of management buyouts for business owners is that sometimes a trade sale is almost impossible, and that could be for different reasons. Very commonly, for small businesses, there might be a very high degree of reliance on key individuals for technical knowledge or customer relationships, or being able to win contracts. It could be a business where there's only one or two key customers, and that would be too much of a risk for a third-party buyer to take on. If one of those key customers were lost, then it's not a risk that they can mitigate at all. It could be a business where there's a lack of visibility over future sales. If it's a lumpy business that's dependent on winning contracts, then those sorts of businesses are very, very difficult to try and sell to trade buyers. But those risks can be overcome through a management buyout structure, and that is because the managers buying the business are only making a limited personal investment. And as we talked about at the beginning of the webinar, the price they're paying is different from the amount that the vendors are receiving for their shares. You can structure a management buyout so that the managers are only investing a relatively insignificant amount of their own money, and the proceeds that the shareholders are receiving is paid from the future cash flows and profits of the business. So because of that, the management, they've mitigated their risk, and they can afford to sort of take on those the inherent risk that's in the business. And the second reason is that the management team will understand those risks in the business to a far better degree than an outsider, a third-party buyer. So if we're talking about a customer concentration risk, then the managers buying the business, they will be the people with the key relationships with those customers. They will know exactly what the actual level of risk is, and how likely it is that those customers might be lost after they've bought the business. They will be the key individuals in the business. So again, that's not a risk in the same way it would be for a third-party buyer. So because they inherently understand the business better, because they're already working in it, then they're in a better position to judge the risks, and that will enable a deal to happen compared to a trade sale. The sixth sort of benefit for vendors is that a management buyout gives a much greater degree of control over the sale process compared to a trade sale. With a trade sale, there's never any guarantee over what the end outcome will be from a sale process. You might find that none of the offers received from potential trade buyers are good enough. It could be that a deal doesn't conclude at the end of a process. The length of time it takes to find a suitable buyer and complete a deal can vary enormously. So it's very difficult to kind of predict with accuracy exactly how a trade sale process will unfold and what the end result will be. Contrast that with a management buyout process. It's possible to plan well in advance for a management buyout, to take advice over what the business is worth, how a management buyout could be structured and funded, whether the shareholders would be retaining a minority shareholding in the business after the buyout. And all of those things can be done in advance, and so before the decision is made to actually push forward with management buyout, the shareholders know exactly what it's going to look like, how long it's going to take to deliver, and be confident that if they do decide to press forward with the management buyout, it can be done. They know what it's going to look like, and they know how long it's going to take and how much it's going to cost. Again, just to repeat what I said on the previous slide, with a management buyout process, a management team can control other features of the transaction. So exactly when they're going to retire from the business, if they're going to remain working in a management role for a period of time after the deal is done, choose which individuals within the management team are going to be invited to participate in the deal, and the overall sort of structure of the deal can be very sort of closely controlled, and that's often something that's attractive to our clients. So far, I've only talked about how great management buyouts are from the point of view of business owners, but of course they can also be fantastic opportunities for managers in businesses when they look to take over their employer's business. And the main reason for this is what we call the gearing effect. And as I've mentioned already, the managers are usually only required to invest a relatively small amount of money compared to the value of the business itself. And on this slide, I've tried to illustrate that. So using the same example as before, let's say we've got a business that's worth £3 million. In this example, the management team invest £200,000 of their own money on day one to acquire the business, and then the other £2.8 million of the funding structure comes from debt, and that would be a mixture of bank debt and deferred consideration owed to the vendors. And let's say we're looking over a 5-year time period. The debt would gradually be paid off over that 5-year period from the profits of the business. So the bank loan gets paid off, the deferred consideration gets paid off, and if we assume that everything else remains exactly the same, the profitability of the business, it remains worth £3 million in year 5, but all of the debt has been repaid, and therefore the equity value, the value of the shares held by the management team, has grown from £200,000 when the deal is done to £3 million after 5 years. So the gearing effect, the effect of using debt to finance the transaction, means that the management team can increase their investment by 15 times over a relatively short period of time. So it's very rare you come across these sorts of opportunities to massively sort of transform your wealth over that sort of period of time. And then the other sort of 2 reasons why management buyouts can be magic for management. One, it's an opportunity to take control and sort of go from being a salaried employee to being in control of a company, being able to secure your long-term future and secure the future of the business that you work for, and having that opportunity to implement your own ideas and not be answerable to other people. And also it really is a once in a lifetime opportunity to transform your wealth. So in the short term, it's unlikely that you'd see much benefit from sort of undertaking a management buyout. It might be possible to negotiate a pay increase at the point that the transaction takes place. But in the medium to long term, once the debt has been repaid to the bank and to the former shareholders, then there's the opportunity to take dividends from the company and really sort of transform your personal wealth. So just the final thing I want to talk about this afternoon is funding and management buyouts. And I'm not going to go into any sort of depth or detail here, but just sort of talk through some of the basic concepts underpinning how management buyouts are funded. So when we're looking to fund management buyouts on behalf of clients, there's basically 4 different categories of funding to look at. So the first being asset-based lending. So here we're talking about debt funding where there is specific security given to a funder and that could be the company's trade debtors, receivables, so invoice finance facilities. So you can put which are conventionally working capital facilities to help a business sort of fund its working capital, but they are regularly used to help fund management buyouts, and they're very useful in that it's a revolving debt facility which doesn't need to be repaid, so you can just borrow money against a company's trade debtors, and then use that finance to not only help the company's working capital needs, but also pay part of the money towards the management buyout. Other types of asset-based lending, stock finance facilities, plant and machinery loans, property loans. So with asset-based lending, it does depend on what type of business it is, whether it's got assets on its balance sheet that can be used as security. If it has, then that's usually the first place to look, and really that's because asset-based lending is fairly easy to obtain and quite inexpensive, in that because there's security in the background for the lender. It's less risky and less expensive than the other type of bank finance, which would be cash flow loans. So the difference here is that this is a loan taken out secured only against the expectation of future cash flows in that business. So they're riskier from the point of view of the lender. If anything goes wrong in the business, then there's nothing they can use as security, really. So for that reason, they're more expensive, they're more difficult to obtain. There's usually a need for due diligence from the vendor in order to obtain this sort of loan. And normally the cash flow loans are usually sort of restricted to larger SMEs, so maybe those making profits over, say, sort of £500,000 a year. So once we've exhausted debt finance options, you've then sort of usually got a fairly substantial gap needed between the value of the business and what can be funded through a bank or other lender. And here, in most cases, we fill that gap through vendor finance, or which is basically deferred consideration, so a promise to pay the former shareholders of the business in the future from future cash flows of the business. That's the most common way of filling that gap, but for some businesses, private equity can be a good option. So if it's a high growth business, and there's the prospect of backing a good management team to grow a business quickly over a fairly short period of time, and then look to exit and make a good return on the investments, then private equity can be a good option and a good way of funding management buyouts. So it depends on the type of business, really, what its balance sheet looks like, how profitable it is, how quickly it's growing. But the key with any sort of funding structure is to make sure that the risk in the business is shared out equitably amongst debt holders, so banks, the vendors, and the management team. So if there's a bank sponsoring a management buyout, they might be prepared to lend, say, half of the money that's needed, and they'll want to see the other half come from either the vendor through deferred consideration or the management team, and that way everyone's kind of taking some risk, and what banks wouldn't be happy with is lending all of the money for a transaction and then them sort of holding the can if things go wrong. I will hand back to Andrew at this point, who's going to just talk about how we can help before we move on to questions.
Thanks, Greg. So just a very quick couple of minutes on how we can help help you achieve your management buyout. As I said earlier, if you've got questions to ask, now is a good time to ask them, because we're going to move on to the question session in a couple of minutes' time. We've had a couple of questions so far. There's still time to ask a question. Just use the Q&A button that's either the top or bottom of your screen. So how can we help? As I said right at the start, we're very keen on giving early stage advice to make sure the transaction that we embark on for our clients can be achieved, is deliverable, is feasible. And we do a number of management buyout feasibility reviews each quarter, really aimed at giving clarity to our client as to what can be achieved. And those MBO feasibility reports are built around an in-depth valuation. So the starting point for us to be able to advise on what can be achieved is us understanding the business in sufficient detail to be able to, first of all, prepare a valuation, and secondly, to be able to advise on what funding sources and the magnitude of funding that's likely to be available. And if we, it's not always clear what is likely to be available. So we often sound out funders on a no names basis and just have a chat with funders that we've done deals with in the past, just to get their views on what can be achieved where necessary. And as part of the report, we'll set out the structure as to what the MBO will look like in terms of its value, how much can be paid on day one, how much will be paid on deferred terms, the sort of level of management equity stake that's required. If there's going to be vendor retained equity, we'll talk about how that can be made to work, really to deliver almost a roadmap as to the deal that can be delivered, give clarity as to the deal that can be delivered, so that the vendors and the management team can sit down around a table, understand what is feasible, what is possible, and agree to hopefully move forwards on a basis that can be delivered. When acting for the outgoing shareholder, sometimes, not often, but sometimes we're asked to also compare and contrast a trade sale process with a management buyout. And where we're doing that, we'd look at deal activity in the sector, we'd track down press releases issued when deals have taken place in the sector, and we'd try and get under the skin of some of those details and get a feel for what's driving the market appetite and what sort of values are being paid. It's not always possible to get a handle on values, because where private companies are involved and listed companies aren't involved, there's no necessity to publish the deal information, so it's not always available. But really, the purpose of this early stage advice is to give clarity as to what can be achieved. Our main service then is to deliver the deal. So we've done the early stage work, the client has agreed what they want to achieve, and at this stage we may be negotiating with the other party, or the management team and the vendors may have sat down, and there may be common ground on what the deal is going to look like. But really, the first stage now is to make sure there's no misunderstanding as to what either negotiate the deal or make sure there's no misunderstanding as to what the deal is that's going to be delivered. And we often get involved in drafting the heads of terms or reviewing the heads of terms. And at that stage, you know what the deal is going to be, and we're at the starting gate really to deliver the deal. Usually that involves preparing a detailed business plan with detailed forecasts, introducing the deal to funders, attending initial meetings with funders, providing funders with information, assisting the management team who are presenting to the funders, and getting to the stage where we've got funding offers, and then advising on those different funding offers and choosing the preferred funder. And then often there'll be a due diligence team appointed by the funder. We will assist where we can, the management team providing information to the due diligence team, and we'll work closely with the accountants who are involved and the solicitors who are involved. It's really a team effort, the client, ourselves, the accountants, the solicitors working together, all pulling the same way, allows the management buyout to happen efficiently and on the right terms. So there's a lot of work in delivering management buyout, and it's really important to maintain the strong relationships. So usually the starting point is the outgoing shareholders have really strong relationships. The management team have been working together for many, many years, and those relationships allow a deal to be delivered efficiently. And yes, there are instances where there'll be disagreements in the process, but usually the relationships and the advice that we give and our ability to foresee issues and solve issues get the deal across the line. So that's how we can help. Firstly, on the early stage advice, giving clarity as to what can be achieved, and then helping get that deal across the line. So at this stage, I'm going to ask Greg to come back in, and Catherine's going to come in and host the, I know we've had another question asked, so please, it's not too late to ask questions. I think we've got at least 3 questions so far, but please, if you wish to ask a question, we'll keep going until 3 o'clock. So there's time to ask the question if you wish to. Catherine.
Thanks, Andrew. Hi, everybody. The first question is this one. Is an MBO realistically possible solely through asset-based lending and vendor finance, and with a very minimal consideration from the management team?
I suspect the answer to most of these questions we're going to get will be it depends, but certainly we've done many deals on that basis. It depends on the circumstances. It depends on, most management buyouts that we are involved with will involve asset-based lending, and most will involve a significant amount on deferred terms. The amount that the management team needs to put in really depends on if there's a cash flow loan involved, where the funders have exhausted hard assets to lend against and are lending effectively against future profitability. They will expect, as Greg has just said, management team to put in a significant amount of hurt money. And that is usually, the starting point for that is usually 1 year's gross salary, depending on the circumstances. But if you can do a deal just on asset-based lending and vendor deferred consideration, then often you can do a deal with very low management equity because the funders are comfortable that they have got security for what they are lending and are not asking the management team to put in a significant amount of hurt money. So the answer is yes, but it depends on the circumstances and depends on how the deal is going to be delivered.
Okay, thanks, Andrew. The next question: how far ahead should you start to plan an MBO?
You want to take that, Greg?
Yeah, it's never too early, really. We regularly sort of carry out sort of MBO feasibility studies for clients who are sort of beginning to think about their eventual exits from their business, and it might be that they're planning a possible sale sort of in 2 or 3, 4 years further down the line. But it helps to start planning at at the earliest sort of opportunity, because there might be things that can be done in the business to help position the company for management buyouts in the coming years. It also allows for the management team to be strengthened and trained up ahead of a transaction, and it's a very good way of retaining key managers in a business as well. If there's a plan to sell out through a management buyout in the future, and that's communicated to the management team, and they are they know that that's the sort of objective for them to work towards, then it can be a good tool to retain those individuals in a business, and that's often a key sort of risk for clients who we're talking to when they're planning their retirement and their exit. That they might be thinking about selling the business to the management team, and then their plans are often scuppered by their managers choosing to leave and do other things before before the MBO takes place. So yeah, I think planning well in advance makes perfect sense.
Okay, thanks, Greg. The last question for now, so please ask a question in the Q&A box if you have one. But the last one for now is, how is COVID impacting on transactions?
Well, I think I'm going to give the same answer. It depends, really. It depends on the business. We have seen some businesses that have done phenomenally well out of COVID, and the profitability will now drop back to more normal levels. And those businesses are where they had contracted income, but they weren't required to give the service during COVID, so they could furlough some staff. We've seen other businesses, businesses supplying the hospitality sector or in the hospitality sector being badly hit, but hopefully are starting to return to more normal levels. In our experience, I guess the vast majority of businesses have, they had a bit of a lean time in March 2020 for a number of weeks in the first lockdown. But most businesses then bounced back, and many of them are now more efficient because they furloughed some staff and found they could operate without the full staff complement, and have let 2 or 3 people go and are operating more efficiently at the same income level. So providing your business, what we're looking forward here, and funders will be looking forward as to what the business is likely to do in the future if we get flare-ups of COVID, and how is it likely to impact your business. And for many businesses, they can show there wasn't a massive impact, or the impact was probably 15 months ago and there's been a much smaller impact since. So it really depends how it's affected your business. But we're doing, as many deals as we ever did, with businesses that weren't really impacted. But we don't really do much in the hospitality sector. So it depends. I don't know if you want to add anything to that, Greg.
No, I think that's right. It really sort of, individual circumstances are the most important thing. So yeah, if in most cases it's not had a long-lasting impact. So yeah, I think we've done 3 management buyouts so far this year, and we see that there's going to be plenty of activity going forward as well.
Okay, thanks, Greg. We've got another question just come in. How much weight is put on the management team's personal circumstances, for example, their income, savings, assets and debts?
The starting point is the weight is put on the management team's ability to be a safe pair of hands to take the business forwards. So the main weight funders will put on it is, are these the right people to take this business forward? What involvement have they had in the past? Are the outgoing shareholders still running it day to day in detail, or are the management team effectively running the business day to day? And do they come across as competent when they're interviewed by funders? Do they come across as understanding the business, not taking undue risks? Are these the right people to take the business forward? Is the starting point and the most important point. If we are talking about cash flow loans, where if the business went pop, the funder's going to lose out because there's very little security behind those cash flow loans, then the funders will want to see that the management team, as Greg said earlier, have put in enough money that would hurt them if they lost it. And in evaluating how much hurt money each person should put in, their personal circumstances are relevant, and members of the management team will usually be asked to fill in an asset and liability statement showing what assets they own, what liabilities they have, just so a funder can see if the 50k they're putting in is a meaningful amount of hurt money, or whether they should be putting a much larger amount in to be a meaningful amount of hurt money. The income, you mentioned income as well. The income is, I suppose, indirectly relevant because often funders start by saying you ought to put in 1 year's gross salary as hurt money. So the higher your gross salary, the higher the amount of hurt money you may be asked to put in. But going back to the previous question, if we're funding the deal just on asset-based lending and vendor deferred consideration, then the hurt money can be at a much lower level.
Okay, thanks, Andrew. That's all the questions for now.
Lovely. Well, thank you very much for listening this afternoon. If you missed part of this webinar, if you joined late, or if you've got colleagues who would like to view it, we have recorded the webinar and it will go on YouTube at some stage this afternoon, or more likely tomorrow morning. We have other webinars coming up on company valuations, and we have a webinar that compares and contrasts a trade sale with a management buyout and looks at the pros and cons of each, and the different circumstances when each type of transaction may be most appropriate. And we'll be repeating this webinar in 2 or 3 months' time. Thank you for listening, and I'm going to bring the webinar to an end at this stage. Catherine will be in touch, sending you a copy of the slides and offering you the opportunity to talk to one of us about your circumstances on a no cost, no obligation basis. So please take advantage of that if that's of interest to you. But as I say, I'll end the webinar now and hope to talk to you in the future. Thank you very much.